Welcome to the art and science of trading as a business. First, I want to talk to you specifically about the program itself and what it hopes to achieve and what the objective of the program is. The objective of the program for the first part is the Money Every Month program is to generate just what it says, money every month. We want to generate a consistent income on a monthly basis in our trades so that just like any other business, we want to generate recurring, consistent monthly income. Does that mean we're going to be profitable every month? Maybe not. Maybe we will. The important point to think about is that we really want to have a monthly income stream. Now, every business manages their business based on numbers, and that's exactly what we're going to do in ours. This is a real business. It's a business in which you are buying and selling. Any business that buys and sells things, you have to buy your stock from someplace and then you sell it to a customer. Well, the very same thing happens in the markets. You're buying and you're selling. Let me give you an example of how we actually try to make our money in the markets as a business. All we're doing is really meeting supply and demand. There are only two absolute rules of the option markets. Those two absolute rules are, number one, prices will fluctuate. Yes, the underlying price of the stock will fluctuate and the individual option prices will fluctuate. Number two, the only other rule, absolute rule of the option market is that these contracts will expire. Any option contract that you buy on any stock will expire at a certain date in the future. If we were to purchase these May options, the ones that we're looking at right now, expire, and we have the expiration date right here in 24 days. Normally, the options expire on equity and index options the third Friday of each month. That is the last trading day for those options. They actually expire the very next day on a Saturday. You have the right as a call buyer to purchase the stock at the strike price that you purchased, in this case $27.50, at any time before the third Friday of May. As we get closer to the third Friday of May, the chances of that stock moving up beyond this strike price of $27.50, above the price of $27.50, becomes less and less certain. And because of that, the option has less value to it. So, I mean, if you take a look at an option like this over time, let's say that the stock doesn't really move. If over time, like a week from now, maybe this option will be selling for 20-cent bid, 35-cent ask. A week after that, it's 15 cents and 20 cents, or 25 cents. The week after that, maybe it's 5 cents and 10 cents. So eventually, the option that you purchased at 40 cents with great hope that the stock was going to move up is now only worth about 10 cents. You've lost 30 cents on the trade. Well, that's exactly what the person who sold it to you is hoping would happen. That in fact that the stock did not go up in price, that you purchased this option that they know is going to expire and will eventually erode in value over time. And that's how they make their profit. Because they sold it to you at 40 cents, they can buy it back at 10 cents, making 30 on that trade. Well, what about the guy who purchased the put option? The option that gives him the right to sell the stock at $27.50, hoping that it would go down so that he could buy it back at $22.50. If he could buy it at $22.50 and sell it at $27.50, he's made a $5 profit. And that's what his hope is. Now, if the stock doesn't do anything at all, the same exact thing is going to happen to his put option. Eventually, over time, because the actual probability that the stock is going to decline in price decreases as these options get closer to expiration, then eventually this option will be worth less and less each week. See, as long as the stock does not move, these options, all of these options will continue to decline in price. The important thing to remember, though, is that when we trade for monthly income, the stock cannot be in two places at one time. At expiration, we're going to make money on one side or the other. And that's an important distinction to make because we make money whether the stock goes up or down. Now, the types of vehicles that we use in order to trade options on the exchanges are normally going to be, and I'll go through all those with you in the next series here in portfolio building. What we're going to be using are adjustments. Adjustments are everything because, as I said, prices fluctuate, and that's one inviolate rule of the market. Prices will fluctuate. We don't care if they go up or down, but they do fluctuate. There's a there's a couple rules of the option markets, and that is that the two I've already told you. The third one is don't lose money. Okay, so yes, the rules are prices fluctuate, options expire at a date in the future, and the third rule is don't lose money. So in order not to lose money, many times we have to do adjustments to our original positions, and this is where a lot of option players make a mistake. They do not adjust their positions. They put a position on, they believe that they can just keep it on there until expiration. Well, they forgot about the other rule of the market, and that is prices will fluctuate. Options expire, but they also fluctuate. So if you get into a position, and a lot of option players do this, they just put positions on and they forget about them, and they don't even look at them until they have a loss. And then it's too late to do any type of adjustment to that position because they're already too far gone. Our goal is to monitor your positions, put these positions on, and then we will show you exactly what you need to do in order to adjust the positions, and that's where the majority of the real profits come in this business. Because, what happens to a business when it's not making money all of a sudden? Well, it's just like this. If we're not making money, then we have to take a look at the source of the problem and adjust our strategy in order to take advantage of new market conditions. And that's exactly what any business has to do. Any business who is not in a profitable position has to take a look at their business model, and exactly what we do in our business of trading. And that's why it really is a business, because we manage by numbers. And that's what all good big businesses do. They manage by numbers. So now this is an aggregate position of our demonstration account for the purpose of these videos. You will see this throughout all the videos that we're creating on this strategy. We start out in a cash position, but I also want to show you what the profit potential of having more contracts. Eventually, as you get experience in this type of trading as a business, you're going to be able to have a great deal of confidence in your ability to adjust trades over time. I suggest that you begin with paper trading. Now, the Thinkorswim platform has a paper trading account that you can set up for free. It looks identical to this. The only thing that is different is if you look up in this top left-hand corner, this is a live trading account. It has a red symbol here with the Thinkorswim symbol and logo. If you have a paper trading account open, this is a green symbol. But the platform is absolutely identical. Everything is exactly the same. You can enter trades, you can adjust trades, you can look at charts, you can monitor your account. You can do everything that you can in a paper trading account with Thinkorswim as you can in this account.